Hey everyone, it's Justin here, America's Honest Tax Accountant from Number Crunch Nerds, and in this three-part video series, we are going to cover how to calculate the tax impact of a Roth IRA conversion. That's what video number 1 is going to be about. We're actually going to run through a calculation. I'm going to show you how to apply the calculation to your personal tax situation, your personal income situation. So we're actually going to crunch the numbers so you can see how a Roth IRA conversion works. So that's video 1. Then in video number 2, we're going to dig into some more details to help decide if you are a good candidate to do a full, a partial, or any Roth IRA conversion. You know, a lot of people don't realize that you can do a partial Roth IRA conversion each year. You don't have to do like the full one all at once. In fact, many times, from a tax perspective, it's more beneficial to you to do a partial conversion year after year. So we're going to look at that. Then finally, in video number 3, we're going to look at what forms you will ultimately receive from your broker or your IRA custodian and how to get that information into TurboTax. So that is what the 3 videos are going to be about. So let's start by setting the stage. If you are thinking about doing a Roth conversion, then the following 2 things should apply to you. Number 1, you currently have at least one traditional IRA, and it possibly could be a 401k rollover from a prior employer. That's a very common situation. You were with an employer, you contributed to the 401k plan, you left the employer, and that 401k was rolled over into what is known as a traditional IRA. That's a very common situation. Or you can contribute, you have been contributing to an IRA separately from your employer. That's also very common. But you have to have at least one traditional IRA, because a Roth conversion is converting a traditional IRA, some or all of it, into a Roth IRA. That's what the conversion is. So if you don't have one of these, then there's nothing to convert. All right, so you're sitting on at least one traditional IRA right now. And then, of course, number 2 is you're trying to figure out if converting some or all of that traditional IRA to a Roth IRA now will be more beneficial to you from a tax and financial planning perspective than just waiting and taking distributions from your traditional IRA later. So those are the 2 things that need to apply to you for this video to apply. If you enjoy this video, please like and subscribe and put any comments or questions that you have in the comments below the video. So let's jump in here. We are going to start with an example. The example is you have $750,000 in your traditional IRA right now. Now, there is no set amount that matters for purposes of this example. You have whatever you have in your traditional IRA. There's no minimum, there's no maximum that's necessary. Whatever you have, you can potentially convert it into a Roth IRA if it makes sense from a tax and financial planning perspective. I'm just using $750 as an example. All right? So, should you start converting this into a Roth, and remember that you don't have to convert it all, you can do it little by little, year by year, to achieve the best tax result. So should we start converting this? Let's jump into a calculation and see how we can figure this out. So step number 1, right, and you're going to do this in your personal income and tax situation. Step number 1 is you want to estimate what is your taxable income, what your taxable income is for the current year. And in a lot of people, you're going to be doing this anyway for purposes of paying your estimated tax payments. But this is going to be step number 1, what your taxable income is for the current year. And how do we do that? How do we do this calculation? Well, it's going to be relatively straightforward. You are going to start by adding up all the categories of income that apply to you. So let's run through what a typical example might look like. We're going to start with wages. That's a very common thing. A lot of people have that. You're going to have it on a W-2, box 1, or it could come off a pay stub. If you don't have your W-2 yet, you can look at a pay stub and multiply your income by 26. 26 assumes that you get paid every other week, right? You get paid 2 times a month, bi-weekly, or bi-monthly, I guess you should say. So there's 52 weeks in a year, so you're getting paid 26 times in a year. So you look at a pay stub, you multiply it by 26, or you look at box 1 of your W-2. Basically, you need to figure out what you're getting paid from your job. This is This is from an employer. This is somebody who holds a job, very common thing. Number 2, the second category of income would be business income, right? This is coming out of your QuickBooks or your Schedule C, or maybe you receive 1099 NECs from people who you work for, companies that you work for as an independent contractor. So if you're running your own business, if you're receiving business income, that is another category of income that you want to put down right here. So in this example, I'm assuming this person earns $100,000 from a job. They have a W-2 for that. They run a separate business on the side. They have $50,000 of business income from that. You could have rental income, right? This will come out of your QuickBooks file. This will come off of your Schedule E, right? If you are familiar with rental income, you've heard of Schedule E on your tax return. So you could have that. You could have pensions. You could have Social Security income. You could have IRA distributions excluding the Roth conversion that is currently under discussion in this video. So any other IRA distributions that you might have would go here. Interest income, if you have any. Dividend income, if you have any. Capital gain income, that would come from things like buying and selling stocks or cryptocurrency. Very common to have capital gain from stuff like that. Or selling any asset that is a capital asset resulting in capital gain. Maybe you have other kinds of income, gambling income, farm income. You will know, based on your personal situation, what typical income categories you have. You can look at your tax return from the prior year to get sort of a rough estimate of how much taxable income you have. The goal here is to estimate your taxable income for the current year. Let's say that this example, we're just going to say this is 2023. So this person has $100,000 wages, $50,000 business income, $10,000 coming from rentals. They're expecting $2,000 in dividend income for a grand total of $162,000. That is an estimate of the total income. So what you want to do is write down these categories and then put in the relevant amounts. If it's 0, just put 0. You don't have to have all of them, but you clearly will have some of these. And so you need to figure out what your estimate of total income is going to be for the year. Let's say for 2023 in this example. Now, after you do that, there's one additional step here. You want to throw in either the standard or itemized deduction right here. Note that most people take the standard deduction. If you have no idea whether you take the standard or itemized deduction, it is highly likely you take the standard deduction. If you itemize your deductions, you probably are going to know that. If you've never heard of itemized deductions, most likely you are taking the standard deduction. So just put the standard deduction right here. The standard deduction for 2023 is $13,850 if you're single. In this example, I'm going to say that this taxpayer is married filing joint, very common. So the standard deduction is $27,700. Here's the amount for head of household. So just put in whatever the relevant amount is for you. On itemized deductions, if you're still wondering, do I itemize deductions? I'm not sure. Ask yourself this question. Do you have home mortgage interest on your personal residence, on your primary residence? That interest, so you have a mortgage, that interest is going to have to be at least $10,000. If you don't have at least that much, chances are you're taking the standard deduction. The other item that could cause you to itemize would be charitable contributions. If you don't have charitable contributions that are at least $5,000, $10,000, chances are you are taking the standard deduction. The only other thing besides charitable contributions and home mortgage interest on your primary residence that would cause you to itemize is going to be medical expenses, and those are going to have to be pretty big. You're going to need to have out-of-pocket medical expenses, probably $20,000, $30,000, $40,000 out of pocket for medical to even have a chance of itemizing. So if you don't have those three things, you're taking the standard deduction. For this video, if you're not sure, just throw in the standard deduction off this table right here. And then ultimately, when you take your income minus your standard deduction, this is going to be your estimate of taxable income. And this is what we're going to use as a starting point to figure out, should you do a Roth IRA conversion? All right, so remember this number, 134,300. And for you, it's going to be whatever ultimately comes out of this calculation. So now, next step, we're going to go here. Step 2 is you want to figure out what tax bracket you are currently in. All right, now remember I just said in step 1 we determined for this example we have $134,300 estimated taxable income. In this example for you it's going to be whatever number you determine. And then after you determine that, you want to go to the tax rate table, right, which I have pasted right here. Here's the tax rate table for a single filer. For this example, we're going to do married filing joint, but you use whatever table applies to you. And if you you can just Google this. Just Google tax brackets for 2023, tax brackets for 2024, and you will find this table in 1,000 different websites. All right, so this is a very easy thing to find. So what you're going to do is you're going to look at the table based on your income, your estimate of taxable income, and you're going to figure out what marginal tax bracket are you in. Okay, so this taxpayer has $134,300. So we're going to go to the table, it's married filing joint. We're going to find the bracket where $134,300 lies. It's going to lie right here in the middle of these two numbers, in between $89,000 and $190,000. This is the marginal tax bracket that this taxpayer is in, 22% bracket. Okay? Now, let's make sure that you understand what the tax brackets mean, because a lot of people get confused on this. So if you're not sure what this means, pay close attention here. In this example, it does not mean that $134,300 will be taxed at 22%. Okay? If you're like, wait, say what? Huh? Listen, let me say that again. In this example, it does not mean that $134,300 will be taxed at 22%. If you don't understand that, you have to pay close attention here, because this is very relevant to ultimately determining if you're going to do a Roth conversion. So here's how it works. The first $22,000 of income for a married filing joint filer is going to be taxed at 10%. All Americans, all taxpayers get the benefit of the lower rates. The first $22,000 of your income, your taxable income, for everybody will be taxed at 10%. Okay? Now, the next $67,450, which I calculated as $89,450 minus $22,000. Okay, so the $67,450 that is in between this number and this number right here, that $67,000 gets taxed at 12%. For all taxpayers, all Americans will be taxed for married filing joint at 12% on the income in this range. All right, so you get the benefit of this bracket, you get the benefit of this bracket. The next $101,300, okay, which I calculated as $197,50 minus $89,450, the amount in between these two numbers, that will be taxed at 22%. Okay, so when you when somebody says I'm in the 22% tax bracket, or I have a 22% marginal tax bracket, it doesn't mean all their income is taxed at 22%. It means the first $22,000 for married filing joint is taxed at 10. The next $67,000 approximately is taxed at 12, and then the next $100,000, which is right between these two numbers, is taxed at 22. Okay, so we're going to take our number, which is $134,300, and we're going to apply these tax brackets, and we're going to see where we're at from a tax perspective, and then we're going to look at doing a conversion from a traditional IRA to a Roth. Okay, you have to know this information in order for the Roth calculation to make any sense. All right, so let's go here. Our estimated taxable income was $134,300. We remember that. So let's run the numbers. The first $22,000 of income will be taxed at $22,000 times 10% is $2,200. The next $67,400, okay, which again is $89,450 minus $22,000, that amount will be taxed at 12%. Okay, so there's $8,000 there of tax. Now, the next amount. Now you say, well, wait a minute. In the last example, I took $197.50. That's true, but we only have $134,300. So you're going to take whatever your actual number is. Okay, if your number does not exceed the top of this bracket, then you're not going to take the number at the top of the bracket. You're going to take your actual number. So $134,300 minus $67,450 minus 22 is going to leave $44,850. And when you add these three numbers up, that gets you to $134,300. So for this taxpayer, $44,850 will be taxed at 22%. And that comes to $9,867. So when you total up these, you're at $20,161 of tax on this amount of taxable income. Again, this amount is not taxed all at 22. Some of it is taxed at 10, some of it is taxed at 12, and the last bit of it is taxed at 22%. All right. So what does this mean from the perspective of doing a Roth conversion? So let's take a look here. And this means that we have $190,750, which is the top of this bracket, less $134,300, which is our income, equals $56,450 more room in the 22% bracket. In other words, we could have another $56,450 more income in 2023, and we could still have that be taxed at 22%. So let's say it slightly differently. In other words, again, we could convert $56,450 from a traditional IRA to a Roth IRA in 2023. This example is for 2023. And it would be taxed, this $56,450 would be taxed at 22%. That's how much room we have left in this bracket. The difference between this actual income that we calculated before and the top of this bracket is $56,450. That's how much room we have left in this bracket. And so if we did a conversion, a partial conversion, let's say, of this amount, it would be taxed at 22%. And $56,450 times 22% is going to be a tax cost of $12,419. So the question is that good or bad? And the only way you can answer, is this good or bad to do this conversion? We need something else to compare it to. Okay, you can't look at a tax situation and go, is that good or bad? Well, you don't know that unless you have something to compare it to. But the very first thing you have to do is figure out how much income do you have already, what tax bracket is it putting you in, and how much room is there still in that tax bracket to pick up income from a conversion from a traditional IRA to a Roth, so that you can get it taxed at this rate, as opposed to another situation we're going to look at right here. We need something to compare it to. So let's go back to our original income calculation and make some adjustments. In this column right here, this is our original calculation. We had the $100,000 of W-2 wages, $50,000 from a business, $10,000 rental, $2,000 dividend. It was $162,000 minus the standard deduction, gave you the $134,300. This is the number we've been working with. Now, let's say that in 2024, you're going to have to do this. You're going to have to think about 2024, 2025. What is your income expectation for yourself in a future period? That is what you have to think about. Let's say you're getting that big promotion at work, or you're getting a big raise. You're like, all right, I'm not going to be at 150 instead of 100. My business is taking off, right? I'm doing really well. People are buying my products or services. I'm expecting my income in 2024 to be substantially higher than in the current year. Let's say 160 instead of 50. Okay, this is what you need to be doing right here. You need to be figuring out what's your estimate for 2023, What's your estimate for 2024? And also, what is your estimate for future years? What is your general expectation? Because this is going to be relevant to whether you want to do some Roth conversion. So let's say your rental properties are taking off. Rents are skyrocketing. You're expecting more money there. You're expecting more money from dividends. Maybe you're planning to sell some stock or something that you've been holding on to for a long time. You're expecting capital gain income. Whatever it is, let's say that your expectation of income for future periods is going to be more. In this case, $395,000. I'm still going to throw in the standard deduction. So that gives me estimated taxable income for this future year of $367,300. Okay, so you need to do this. This is how you figure out if you should convert some of your traditional IRA into a Roth. All right. So remember these two numbers. We have the 134.3 that we've been working with. Now we have a new expectation of substantially higher income in a future year. So let's go to the next slide here. Our estimate of taxable income now for 2024 was $367,300. And so we're going to do the exact same thing here, just like before. The first $22,000 gets taxed at 10%. The next $67,000 gets taxed at 12%. Now, in this case, we have substantially more. So we are going to max out this bracket with the total amount. So this is going to be the $197.50, which is the top of the bracket, minus the amount in the previous bracket, minus the amount in the bracket before that. And so the full $101,300 will be taxed at 22%. And then the next $173,450, okay, which again is $364,200, the top of the bracket, minus the amounts in all the previous brackets, that's going to be taxed at 24% right here. And then finally, in this example, because we have $367,300, there's an additional $3,100 that goes into this bracket. That's going to be taxed at 32%. All right. So when you add up all these numbers, that's how you get to your total taxable income estimate. And this would be the total amount of tax right here on that. Now, what is this telling us? Okay, it's telling us that any Roth IRA conversion in 2024, under this scenario, would be taxed at 32%, right? Because this is your income before you consider any conversion. So if you do a conversion, that income is going to fall into this bracket, into your marginal tax bracket, which in this case is 32%. So let's go back and check out the difference. In the previous scenario, we converted $56,450 to a Roth IRA in 2023 at 22% for a tax cost of $12,419. Remember, if we go back to right here, $12,419, we asked, is that good or is that bad? Well, in this example, if we wait to do any conversion into 2024 and we're expecting significantly more income, then guess what? Any conversion we do is going to be at 32%. So in the current scenario, we assume we convert the same $56,450 to a Roth in 2024, now at a 32% marginal rate. The tax cost is going to be $56,450 times 32% is $18,064. That is an additional $5,645 of tax on the same amount of money converted, right? If you convert at the lower rates, your tax is going to be this. If you convert at the higher rates, your tax is going to be this. And how do you know what rate you're potentially converting at? By doing your estimate of your income for the year and figuring out, am I expecting more income next year? Am I expecting less income next year? What am I expecting already from my job, from my business, from my pension, from my dividends, my capital gains, etc.? And what bracket is that putting me in? And how much room do I have left in that bracket where I could potentially convert at a lower rate before I get kicked into the next bracket? All right, so let's go here. So is doing a Roth conversion worth it? The answer, as you can see from this video, is it depends on what tax bracket are you in now versus what tax bracket do you expect to be in the future. And that will be affected primarily by two broad things. One is your personal taxable income situation, and that is what we just went over right here. This is your personal taxable income situation. You have to figure out what is your expectation of income from your job, from your business, from rental properties, from dividends, from pensions, from Social Security. Add all that up. Try to figure out what is your estimate. It doesn't have to be perfect. It doesn't have to be down to the dollar, but you should have some rough idea. What am I expecting now? What am I expecting later? And if you want to run this into 25, 26, 27, you can do the same exact thing again. All right? That's what we went over right now, your personal taxable income situation. But the second thing, the impact of tax law changes. This is another thing that can affect your ability, or it can affect what tax rate you're ultimately going to be doing a Roth conversion at. The impact of tax law changes, which could put you in a different tax bracket in the future, even if you have the same income situation. Okay? That's what we're going to look at in part two of this video series. Part 2 of this Roth conversion video series, we're going to run through a bunch of different scenarios now that we've kind of set the stage of the basics of how you figure out if you should do a Roth IRA conversion. We're going to look at income considerations. We're going to look at future tax law change considerations. We're going to consider cash flow needs that you may have, and also your ability to pay the tax on the conversion, ideally out of external funds, okay? Because when you do the conversion, you are incurring tax now, right? You're incurring tax now in order to save tax later. Like in this example, if you converted this 56,450 in 2023 at a 22% rate, you are paying 12,419, but if you waited till next year under this scenario, you're paying 18,064 to do the same amount. So you can save a total of 5,645 of tax in this example by converting now instead of waiting until a future period when your income is going to be higher. That's what we're trying to figure out. Should I convert now? Do I have room in this bracket to get some of this converted at a lower rate than ultimately what I'm expecting to pay in the future? So we're going to run through more scenarios to help clarify future expectations of income, future tax law changes, cash flow needs, etc. So I will see you in part 2. If you can't find it, there should be a link below this video once part 2 is made, but if you can't find it, just search in YouTube for Number Crunch Nerds, Roth IRA Conversion, and I will see you in the next video.